When you look at risk management, it's very tangible, it's very personal, because it's not other people's money, it's your money. We manage our portfolio daily. We look for every reason why I'm wrong. There's no ego involved. It's not so much about the company announcing the results, the earnings, and so on and so on. It's really, for me, how did they do it? For us, I'll start with rigorous research. I don't read any sell-side research. That's the first thing. Every company in our portfolio is dissected. Investigative research, I call it. It's not so much about the company announcing the results, the earnings, and so on and so on. It's really, for me, how did they do it? Look underneath the hood. For example, I had a company, spoke to the CEO for a bit of time, and I start calling the company's competitors. I call their customers. I'm talking to the customer's receptionist. I'm talking to everybody and say, hi, how are these guys doing? Do you like their products? What makes them better than the competitors? Would you continue to, I think just the questions of when you are an owner of a company, asking those questions as to why this company today should be worth more tomorrow. So that's what I do. And the CEO got mad. She called me and started yelling at me because she thought I was being too intrusive. But that's how we do things. That's how I do things. It's not so just looking at a press release and saying, great, you beat the EPS by 2 pennies. Let me buy your stock today. It's all about digging under the hood. Yeah, risk management for us isn't just a phrase. It's very personal because first thing is that myself, the other principals of the firm, we have a very, very significant chunk of our net worth in the fund. We have never taken a single dollar out of the fund. We, in fact, have reinvested back in the fund our performance fees, our management fees back into the fund. So when you look at risk management, it's very tangible, it's very personal, because it's not other people's money, it's your money. So when I come across transactions of potential investments, I look at it and think about, well, it's my money. Do I want my money in this? And that's an easy thing to say because then you're not trying to sell yourself. A lot of times when it's other people's money, you could convince yourself, it's a 50-50 shot. It's a good shot though. I don't, because it's right there in front of me. That's the first part. Second part is that we manage our portfolio daily, and we look at, I call it trap doors. We look for every reason why I'm wrong. There's no ego involved. There have been times when I got into a position, a holding, and literally within a week, I flipped out of it. I made a mistake. It happened. Doing so ensures that you can always walk out of the position versus getting carried out of the position. That's financially a big difference. I grew up when Microsoft went public. You hear a story, you invested $10,000 into Microsoft, an IPO, it'd be worth $3-4 million today. Then you hear about the Berkshire Hathaway. And when I construct a portfolio, it's not about making money today and flipping out tomorrow. You might get more aggressive, do things to hit your hurdles, and you might do things to make your performance potentially look better. I don't care what my performance is. Then it is what it is. And I say that a lot. It is what it is. I look at the performance over the long term because that's how our LPs have a peace of mind in knowing that we're not taking any needless risk or chances just to make a quarter better, to make a month look better, or because we're chasing somebody on the performance ranking tables, okay? It is what it is. As an investor in a fund, myself personally, my family's money in it, that's my approach. We recently had an investment in a company called Zero Capital, which is a publicly traded company It's a BDC, except it's more of a venture capital BDC. Traditional BDCs pay out monthly dividends, quarterly distributions, they loan money out. They took equity stakes in companies. We've been in the company for several years, and we're fortunate we always made money in it. We took this last round a position in the company because the net asset value for the company was, according to the press releases, was $7.39 roughly. The stock was trading at about $4 a share. My calculations were probably in the neighborhood of about $5.50, $6 roughly in that area. Lower than the company's estimates, but still higher than the stock price. I had a lot of cushion in it. I was okay with that. I was happy with that. Then I started digging into the company, as I always have, and a few things bothered me. First thing that bothered me was that they had one holding investment where I believe the CEO's brother was on the other side of that investment. The company lost $10 million, marked their investment down about $10 million. That kind of bothered me, that kind of expensive nepotism at shareholders' expense. The second thing that was that I started calling the directors. One director was, not to say insulting, but he had a car dealership, but no one ever answered the phone there. A second director had two phone numbers. I called, numbers didn't work. Okay, that's a little strange too. Left a message for a third one, never got a phone call back. The stock has gone down in the last 3 years from mid-teens to $4 a share. If the stock was reversed, stock's higher, no one's gonna bother. The stock's higher, who cares, right? No one's gonna look when times are good. When things just don't add up, when things just bother me, I say goodbye to the position. I got out of that position. We had an investment, a company called NL Industries a few years ago. NL Industries was a holding company that had holdings in Valhai, TimeMed, which was bought out subsequently later on, and a few other companies. Stock was about $8 a share. But all its holdings, they're all publicly traded holdings. Chronos was close to being $15, $16 a share, which is a market discount, a big discount, so I bought the shares. NL Industries stands for National Lead. 40, 50 years ago, lead was a bad thing. It was asbestos. At the time, a few other companies, including ConAgra. People know ConAgra today because they sell food, frozen foods. But ConAgra back then was a very, very big seller of paint. So over the years, after they discovered lead paint was not good, they took it off the shelf, and that was done. Over the years, there's always been a lot of lawsuits from states, from New Jersey, Wisconsin, suing these companies. Industry was always saying, once we were told that we took it off the market and washed our hands of it, and we're sorry, we didn't know, we moved on. Except in California, an enterprising county attorney general filed a lawsuit against the lead companies. He won the lawsuit. I'm like, what? Okay. So they appealed it to the California appellates. I didn't know anything about that, the legal system out there, because every city, state's different. But I didn't know I found out the one thing by accident, but through digging research. In California, if you put the case number down, when there's a decision, they will send you an email telling what the decision was. Everybody had assumed, including me, that the appellate court would hear this case, appeal it, call it a day. They didn't do it. That means that verdict's gonna stand. Worse, that verdict could potentially open up now to every other jurisdiction, every other young DA, enterprising DA across the land and say, hi, I'm filing a suit against this company, and look, they said yes over there. This case is moving forward. So I got the decision over the weekend that I got an email saying they're not gonna open it. So the whole weekend thinking, okay, Monday I'm gonna sweat this position out. Monday I diligently, quietly, stealthily got rid of my whole position. That's a situation that you do all the homework you can, do the research you can, and there's just sometimes it goes against you. But the thing was, in that situation, like all the situations, that we manage our position every day. So when something happens like that, you catch it because you read the K filing, the AK filing. You read these filings. You read the press releases. You read the news item in some local periodical. And those things are so important because, again, a lot of times no one picks up on it. That's what separates us from that situation, because we saved ourselves a loss in that position. The market neutral tag really came because it was defined our strategy. We hedge our positions using options. It allows us, the way I run the strategy, we make money on an absolute basis, regardless of the markets. Right now, our last negative month was March 2020. And as I told our LPs, we were chasing Pete Rose. Excuse the baseball term, I'm a big baseball fan. We were chasing his 44 consecutive games of hits, and we passed him. We're now at 50, and now we're chasing Joe DiMaggio, 56 game hitting streak. The market neutral label, it really is just has been defined by how we do things. We run a long-short portfolio with options overlay. What that means is we look at companies that we want to go long on, hope it goes higher. Short companies we think will go lower. We're a fundamentalist shop. We're research-driven. We're like the anti-quant. We're the anti-algo. We use options as a means to hedge our existing positions. We use options as a disciplined form of accumulating positions too. That's important to say because the strategy takes a lot of the emotions out. Investing is human related. I know right now, for example, we have a second coming of meme stocks again recently, okay? And everybody's saying about, these companies as meme stocks, there's no value. But the reality is that people forget the really most important thing about the stock market. Prices could be defined by different measures, P ratios, cash flow, debt, income statement, so on and so on. But what drives the stock is demand supply. If there's more people buying the stock, regardless of the reason, because it could be meme stocks, it could be growth stocks, momentum investing, value investing, pick a phrase. They're all driven by the fact that it is demand-driven on the upside and supply-driven on the sell side. People fundamentally forget that main thing. It's almost like, I was relating this recently. It's like roulette. When I was younger, much younger, I would go to the casino and I would lose my shirt, my boxers, my socks at a roulette table. Because I would see, wow, the roulette table spun 7 black in a row. It's got to turn red 8th time. Put $20 on red, black again. Double down, $40, black again. $80. Then when I ran out of money, and it happened because I forgot the most important part of the strategy. Every spin is an independent event. And you could say what you want to say, or what the value of these companies are, but it's driven by demand supply, buying and selling. So for us, our strategy, from the research side to the options portfolio construction side of it, our risk side of it, it's so disciplined, it removes my emotion out of it. Again, having gone through whatever dislocation and so on, I sell options to hedge our positions. For example, on the long side, we sell calls against that. Selling calls against your positions, it lowers your cost basis. It also limits the upside. It's a trade-off that I'm happy to make because you're making money 67% of the time, mathematically speaking. If you're long a position, let's just say, for example, I bought a stock at, let's just say, $50 a share, and I'm selling options at 60, 70 at high strike prices. At the day of expiration, if the stock's at 50, you broke even stock, but all the money you collected from the sale of the options is yours. So that's your profit. If the stock goes to 60, 70 higher, great. You get to sell some at that price. You still make money in stock. If stock's lower, that doesn't mean you lose money, because if the option premium you got was more than the downside stock, you're still ahead. I explained this in a non-stock market way. Let's just say that you own a house. I come to the house, I say, I love your house. I'm not sure I want to buy it. Let us say that your house is worth $100,000. I'll give you $5,000 1 month rent. After the month is over, if I like it, I'll give you the $100,000. If I don't like it, I move out. The $5,000 is yours to keep. Month goes by. I say to you, you know what? I can't live here. Your neighbors are throwing toga parties every single night. I can't get any sleep. So here's the $5,000. You got my rent. I'm moving out. You say, thanks. You made $5,000 for the month. Great. Let's just say, for example, I moved out because your roof is leaking, you got foundation problems, you have insects everywhere. Your house isn't worth $100,000, it's worth only $90,000. I'm moving out. You lost $10,000 value in your house, but you got $5,000 from the rent. So you're only down $5,000 versus if you didn't sell the options, you'd be down $10,000. Third scenario, I discovered an oil well in your backyard. This house is worth $120,000. I'm never moving out. Thanks, I'm buying a house for this money, I'm done. So again, you live your upside, but you still make money in the house. You're happy. You got the house, you got the price you wanted for the house, you collected also rent money from that. The probability of you making money on that is higher, percentage-wise. The big risk in that is that the value of your house drops down significantly, which more than the money you got from the rent money, the sale of the options. That's a risk. But however, if you just had that one position and you held it and it went down the same way, you still lose money. But at least on this side, you're buffered a little bit because you got some money from the rent money, if you will, okay? So you've had $100,000 where you didn't sell any option, didn't collect any rent money, stock goes to zero, you lose $100,000. In this example, you have $100,000, but collected $5,000 in rent, you lost $95,000. Okay, still hurts, but you lost less. To manage the credit profile of my holdings, I tend to avoid companies that are heavily leveraged or losing money. And I know that sounds very sophomoric or simplistic, but I don't like to complicate. Let's try to convince myself of a restructuring story, or if the yen did this, if the yields did that, and they sold this division, their balance sheet would only be 3.9x of leverage. So I tend to avoid those companies as a whole. A credit strategy would be useful for me because if I found a company that has excess cash above their needs on their balance sheet, that's when it's an awesome thing for me, because then it's not a matter of if, it's a matter of when that balance sheet gets recognized. And as long as if the company is just floating and just gliding along, I'm okay with that because I know that they'll be here tomorrow.